Okay traders, welcome back to the channel. Here we have the 15-minute chart of the S&P 500 and we're going to be going over a quick buy trade case study, right? Just before we had this massive sell-off over here of one of the trades I took recently this week, and we're going to be dissecting how you could have got involved, looking at entry models, timing, liquidity, and other basic ICT concepts. But just before we get involved in that video, and just before we get involved in today's video, just want to say that we're offering a 30% off every single package at Liquid FX. So that includes free one-to-one sessions once a week with myself. That includes full Discord access, including Q&A sessions 24/7, as well as Discord support, full course, and one-to-one sessions and live webinars. So if that's something that interests you for very affordable pricing, 30% off, then that could be something you're interested in. So let's get involved in the video. So what we had over here is we had price again breaking structure to the downside over here. So we had price giving us very clear swings to work with, right? So we had a swing high up here where the Fibonacci tool begins, and we had a swing low all the way down here where the Fibonacci ends. And so from here we have two very distinct regions to work with, right? We understand everything above this 50% level becomes a premium, and we understand everything below this 50% level becomes a discount. And so from here, the main purpose of this trade, the main driving factor of this trade was essentially looking to buy below an old low. So we're looking to, so if price here has broken structure, right? We've broken structure to the downside. The question now becomes, what do we do in this region, right? So we've had a break of structure to the downside, right? And we're presented with our premium and discount arrays. So this trade was simply looking to buy below an old low. That's all you're doing, looking to buy below an old low. So this is simply the framework of this trade. Now the entry model is very important, and we are going to be going over the entry model on the S&P 500 on this trade, but it's important to understand the framework of this trade. So this was a buy trade below an old low after a break of structure. So we're looking for what we call a Wyckoff accumulation, or just an accumulation of price below the old lows, right? Very important to understand this, right? So again, how we know from ICT concepts is IPTA, the interbank price delivery algorithm, will simply look to trade from a discount region up to a premium region, right? This is essentially one of the key aspects of the market, especially from an ICT perspective. So here we're going to be going over an M15 version of the entry, although you can use lower time frames to refine your entry. I typically don't show that on YouTube. That's more for the members, right? The lower time frame stuff. But the higher time frame stuff is something I'm willing to share because it can all be replicated on the lower time frames if you put in that work. So what we have over here is we have a very important range, which I bang on about in every single video, which is the Asian session range, right? So this Asian session range has two data points that we're going to be working with. We have the Asian low, right? That we see price sweep it at its lowest point over here, right? So this here represents an Asian range low sweep, just like this. Now we see just before price sweeps the Asian low, we see the Asian high getting swept. So we see price giving a sweep of this nature. So we understand we have two very distinct points in the market. So our job is to understand what happens and why. So first we need to understand, we see price eventually sweeping the Asian high up here first before giving that low of the day. So this is what we call a manipulation phase one. And you have to ask yourself, why does the market do this? So the market does this for one very simple reason, right? But it's something that people need to understand. This here entices early buyers into the market, right? So when you see price break out of a range and shoot higher, what are people going to be doing, right? People are naturally going to have stop losses around sort of this level over here, where I've drawn the red line. When people sell from here, right? When people shoot up, right, they're looking to buy. Sorry, so this entices early buys into the market, and therefore they're going to have stop losses around this sort of region over here, right, where these equal lows are, right? This is manipulation phase one. This here entices early buyers into the market, right? This is one of the entry models that I use, right? So this entices early buyers. Now, after we see a sweep of the Asian high, price actually comes down pretty aggressively and sweeps the Asian low. So you want to ask yourself, what does this mean? What does this occur? Now, this potential move in the market has many different names, which I'm sure you've heard all over YouTube. I typically refer to it as two things. I either refer to it as quite commonly the Judas swing, classic ICT concepts, or in this example, we can call it the manipulation phase two, right? Manipulation phase two. So they really both mean the same thing, right? You can use these two phrases interchangeably. And what it represents is it represents manipulation the other way from early buyers. Now we're enticing sellers. Early sellers, just sellers as a whole, right? So when we have sellers in this region, their stop losses are going to be up here somewhere, like I mentioned earlier. And as you can see, they get wrecked, right? So how can you avoid getting wrecked by the market? Well, it's important to understand time-based liquidity entry models. Very, very important. Time-based liquidity entry models. We already know from what I said earlier about buying below old lows, we should already be looking for buys. And so because of that, we are looking for price to sweep the Asian low as an establishment that we've seen bearish manipulation, right? This is bullish manipulation. This is bearish manipulation. So to quickly go over that, right? When we have an accumulation, right? When we have a range just like this, the range will produce two types of liquidity, right? You've already guessed what they are. Their buy side up here and their sell side down here, right? So when we are looking to go long, when we see a sweep of buy side liquidity first, what we're seeing is we're seeing early buyers getting enticed, right? Why are these early buyers, right? Why is this an early buy manipulation? Well, you have to look at the time because remember everything is time and then price with ICT concepts. This here occurs at 1 p.m., right? So this specific day, we saw the Asian high manipulation at 1 p.m., which actually corresponds to 8 a.m. Eastern Standard Time, right? But you have to understand the indices market opens at 9:30, right? So anything before that is essentially before the true open, right? Before the true open. So therefore, any price action before that 9:30 Eastern open time is deemed as manipulation. 8 times out of 10, 9 times out of 10, right? This is going to be an early buyer or a manipulation phase one. Okay. So now when the volume begins to kick in at 9 o'clock, quarter past 9, 9:30, what we see is we see price manipulating the other way before creating a Judas swing and aggressively heading higher, right? So this here typically represents our Judas swing. So this Judas swing over here is what we can refer to as manipulation phase 2. So what is the purpose of manipulation phase 2, right? If I could label this manipulation phase 2. So what is the purpose of manipulation phase 2? So the purpose of manipulation phase 2, what we see over here, is we're seeing sellers enticed to the market, and this then engineers buy side liquidity all the way up in this region over here, right? So this then engineers buy side liquidity, right? And our next and final job is to key off a fair value gap, right? Fair value gaps are quite easy to identify. It's just understanding that fair value gaps, just like liquidity, have to be time respected, right? So we need to understand that the fair value gap, which is this one over here in this example, this fair value gap actually occurs, right? So this is an ICT fair value gap that occurs in the AM New York session, right? So that AM New York session has got to be earliest 9:30 but latest 11 a.m., right? This is typically when you want to be trading and looking for the fair value gaps between 9:30 and 11 a.m. I stress this is Eastern Standard Time. I'll even write that over here. This is Eastern Standard Time. So your job from here is to simply key off a fair value gap. So if I just make the charts a bit cleaner, what you're looking to do is you're looking to key off a fair value gap, right? So we have an order block from the fair value gap, right? And you want to have your stop loss just below the Judas swing or that set or that phase 2 manipulation over here. And where do you want to target? Well, like I said at the start of the video, you want to be trading from discount to premium. So we're in discount over here, and your job is to buy up into premium. And a great place to target will be the previous day high. Remember, previous day high is a very high probability liquidity point, right? So we have the Tuesday high over here. This trade was on Wednesday. We have the previous day high over here. So this is Tuesday's high the day before. PDH represents previous day high. Okay, so this here represents where you want to be targeting as the trader, right? Previous day high. And as you can see, that gives you a 2.5 R trade. So a very good trade, excellent trade that you could have taken. Scalp trade held overnight. Considerable RR, great trade, and simple counter trend logic using the concept of accumulation, manipulation, and distribution. So it all comes down to this concept over here that we discussed in the schematic, right? We have manipulation phase 1, enticing early buyers. We have manipulation phase 2, and we're simply from here at this point looking for a clear shift of market structure. So MSS, or a market structure shift, or a break of structure, or a chalk, or whatever you want to call it. Lots of fancy words these days. And your job is to simply key off fair value gap in this level before heading higher. So that's very, very simply how the two-phase manipulation model works.